How well could you stomach a 10 or 15% decline in your stock portfolio? That's exactly what we could be in for going into 2025. Now, when we think of 2024, the S&P 500 is up close to 28%, which is kind of crazy for an entire year. Even going back to 2023, we've seen a 24% gain, not too shabby at all, with double-digit growth over the last 2 years. Now, 2025 could be uncertain time, but the economy has really held strong. Looking at the labor market has been strong, inflation has been declining, and of course, the Federal Reserve is continuing to lower rates, including the rate reduction we've seen in December. But a lot of market strategists and a lot of people are predicting that 25 could be a solid year, but it seems like there is going to be some point, and there has to be when you start looking at the price to earnings ratio, when we need to see a 10 or 15% pullback or a decline in the portfolios next year. So let's explore exactly why we're going to see this. Now, when it comes to the market is a delicate thing that has incredible strength through a couple of last years. Really looking at COVID, thinking of the year that followed, how absolutely kind of decimated it was going into 2021. And then, of course, 2022, kind of the same. 23, 24 being absolute phenomenal years. Now, when we start thinking of the broader index, thinking of that S&P 500, which has 504 companies, most of the companies in there are not posing that 24, 28% growth. However, there are 155 stocks in the index that have had zero gains or negative gains this year. So when you think of the larger mega cap stocks, they are the ones that are carrying a lot of the S&P 500 when it comes to the market weighted average. It might be a little bit more delicate than a lot of people think. And that's why we've seen some companies like Goldman Sachs have said we might only see like a 0 to 3% growth over the next couple of years. A couple companies have said we're seeing 5 to 7. Even a few have said 10 plus that the stock market is going to be on fire going into 2025. So when we start thinking of 360 names in the S&P 500, 360 names have generated less than that 28% average that we're looking for the return of 2024. But when you look at just a dozen names, so roughly 12 names, really pointing out NVIDIA, looking at Planeteer, there have been a couple companies and some of these larger companies that have doubled or even tripled in their stock value, being able to, because of their size, carry the market. And of course, a lot that we have seen have been based off the play of the artificial intelligence. And now we're starting to see a lot more of the quantum computing coming into that space as well. And when you start looking at stretching multiples, even when we've seen stock splits, even a lot of the stocks have went up a lot more, which means that they could be a lot more susceptible from that price to earnings ratio to a pullback and a sell-off, and could take the market down with them. Just like, again, a dozen stocks really carried the market. If we start seeing some of those stocks being sold a little bit more often, you could see a lot more of a sell-off. And of course, this is the reason why we do this, and really thinking of the Warren Buffett philosophy, where if you can't stomach the market going down 5, 10, 15, 20%, then you shouldn't be investing at all. When you look at investors, they are still very touchy when it comes to the news, even looking at social media to go ahead and sell, even though they've had, and not realizing the kind of crazy last 2 years that we've seen with returns, with the very little taste or slight miss with something in the media, with something in the news itself, can trigger a sell and can trigger a very fast sell. And we've seen it now with crypto kind of testing when it comes to Bitcoin, and when it comes to testing that $92,000 mark. It peaked at about 106, and it's back to, I believe, the high 90,000s, 90, 95, 96 right now. But of course, that's going to make a big difference on what 2025 comes up, because of course, we have a few things. One, the presidential election we know is going to take office. President Trump is going to take office in January, which could affect a lot of the outcome of the state of the United States, as well as global markets in general. Also, we're going to see a lot of things from the Federal Reserve, including the anticipated rate reduction, which we don't know exactly how long or how low they're going to go when it comes to the prime rate. That is kind of yet to be seen. When you start thinking of a severe recession, talking 30, 40, 50%, don't think it's going to get that severe. Don't think we're really going to see that. But you can also peg this and really poise it as an absolute phenomenal opportunity to, one, know your research, do your research, get into investing, because as the market declines, it is one of my absolute favorite times. It is like Christmas morning when I see some of that S&P 500 starting to pull back as I continue to buy and continue to buy. It is something that I absolutely love to do. And in 2025, if we see a 10 to 15% pullback, that's exactly what I'm going to be doing, is continuing to buy. Now, when we start thinking of that 10% correction, they are actually super common when you start looking at a bigger picture. Again, we start thinking of the last 2 years have been incredibly well. When you start looking back at the last 30, 50, even more years, 10% correction is very common in the marketplace. When you look between 2002 and 2021, the market fell 10% in 10 of the 20 years, with the average pullback being 15%. Think about that for a minute. So if you have 20 years in its entirety, 50% or 10 of those 20 years seeing a pullback of 10% or higher, with the average pullback being 15%. So if you were investing when the market is declining or when the market is pulling back, you are going to be poised to make an incredible amount of gains when the market rebounds. So if you think about it, and almost like a yo-yo, where if you're buying when it's going up, great. Then if you're buying when it's going down, even the price average is going to be a lot lower than when you were buying at that high level. Then when it goes back up, you're going to own significantly more shares of something like the S&P 500 fund, and you're going to see really, really big gains. Now, a perfect example of this with my portfolio, we started in 22 when the market was declining, started to decline significantly. We continued to buy and buy and buy through dollar cost averaging. And then in 23 and 24, we've seen a really big increase in the market, which means we are up almost 100% overall in the portfolio over the last 3 years. Last I looked, it was like 96 and some change. Even again, buying as the market really goes down and then seeing the correction or the increase in the market in the future has made a really big difference. Now, when you start looking, corrections have occurred more recently with events, and they really do hinge around a lot of events. When you think of 2020 at the start of COVID, we've seen it go down dramatically, even going early 2022, when the Fed started intensely increasing rates and really going crazy. Russia started getting involved with the Ukraine, all of the war there. The S&P did experience a 10% correction in 23, but has not had one in 2024. So there hasn't been any pullback, hasn't been anything like that. Now, of course, past trends, history, you cannot guarantee the exact same outcome in the future, even though it could change and we could see all record highs. I believe this year we're ending at 54 or 56 record highs that we have seen this year, which is crazy. So even if the market does decline, guys, it is about dollar cost averaging. It's about putting money consistently into these investment accounts through the 401k plans, through those Roth plans, through your brokerage account. If you're investing on a consistent basis, if you're investing that 10 to 15% that is recommended, you will come out on top in the long run. And of course, when we talk about investing and when we talk about long-term investing, it doesn't make a difference on the corrections. You're buying it when it's going up, you're buying it when it's going down, and of course, you're buying it while it is in the dip phase as well. And of course, prepared when it comes to long-term investing, you are thinking 5+ years at a minimum. Now, I say that at a minimum because that is how long you need to be invested in the market to really get the averages that we talk about. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.